Good morning. It's Keith here. Thanks as always for joining me for another edition of today's 5 with Fitz. The markets are once again in a foul mood. Oh man, lots of people are saying, but I'm saying perfect. There's only one decision you need to make, and that's what you've got an opportunity to do on days like today. The question you want to ask yourself is, are you an investor or are you a trader? Now, most people, particularly aspiring investors and traders, think you can be both until a series of big down days force the issue and they find out, unfortunately, the hard way that they're not who they think they are. Now, to be clear, there is plenty of opportunity on both paths, just not at the same time. If you're a trader, what's happening right now is your Super Bowl. You should be celebrating the craziness and making money hand over fist. If you're not, something's wrong. If you're an investor, the best deals of the year, and dare I say it, potentially the next decade are on the table at this very moment. You should also be celebrating the craziness because the real money inevitably gets made when the bears come out to play. It's just not apparent until much later when whatever crisis du jour has faded into the rearview mirror. Now, my POV, having done this in global markets for 45 years, is very simple. If you are not investing when the chips are down, you will not be ahead of the game when they're up. Simple as that. Courage isn't free, but neither are the biggest wins. Which one are you? It's game time. Make your choice. Here's my playbook today, by the way. Number one, this company sees revenues growing 5x by 2030. That's not that far away, folks. Rheinmetall, an European defense giant, has told investors it expects sales to surge from roughly 10 billion euros today to 50 billion euros by 2030, a five-fold jump powered by record demand for weapon systems as tensions rise across Ukraine, Middle East, and beyond. Now, shares, of course, popped on the news and are already up nearly 190% this year. Should you buy it? Well, that depends on your view, like many things. Mine is that we are entering a new defense economy where sustained conflict, fragile supply chains, and rising geopolitical fragmentation are creating a multi-year demand cycle across everything from munitions to mobility to maritime systems. Now, the companies that are best aligned with those needs are rewriting growth curves most investors still think of as defense staples, drone and missile defense specifically. Now, as great as Rheinmetall is, I'd rather go with a different choice, but that's just me. One that's considerably less volatile and still has a far larger portfolio. You may think differently. I think Rheinmetall is probably going to get you there if you invest in it, but again, that's you. I'm going to do me. War, terrorism, and ugliness are unfortunately a growth industry. Now, hopefully you've got this covered in your own investing or at least thinking about along similar lines. If you'd like some help, you know where to find me. Number two today, Home Depot to its customers. Please remodel something, anything. Hello? I made no bones about this during a TV appearance Monday morning ahead of the opening bell. Home Depot wouldn't live up to expectations again. Now, it seems I might have been onto something. I hope you paid attention and stayed away from the stock as I have repeatedly encouraged over the past few years. The company had expected home improvement demand to pick up as mortgage rates ease and consumers felt a little more confident. Instead, big ticket projects are being deferred, storm-related spending didn't materialize, and customers across all income groups are hesitating before taking on anything that remotely requires borrowing. To paraphrase myself on Monday, they'll buy a sink, but they won't redo the bathroom. They'll replace a light fixture, but not upgrade the kitchen. Wallets remain stretched, folks. Rates remain high, and shoppers remain cautious. Foot traffic, of course, is steady, but the average basket is shrinking. And that's exactly what I told you to watch. Now, what really jumped out at me, though, in this earnings call is that Home Depot held on to its full year guidance anyway. Now, I'm scratching my head because I don't understand how this is possible. When a retailer keeps its outlook steady despite softer demand, it usually means one thing. Price hikes are coming down the line or something else is going to give. Now, I'm not inclined to hang around both literally or figuratively. Home Depot, anecdotally speaking, has repeatedly delayed a simple flooring order delivery that we placed for more than 2 weeks now with no explanation whatsoever. In the meantime, I've been receiving a bunch of fake cheery, hi, how we doing, rate us emails and a blizzard of marketing garbage when they aren't doing a great job in the first place. Personally, I'm thinking I should have gone to Lowe's. Makes my head explode. Anyway, number 3, no, Netflix didn't really drop 90% this morning. Now, many folks did a double take earlier today. Netflix shares briefly looked like they had collapsed nearly 90% on Monday morning after a data glitch related to the company's 10-for-1 stock split. Now, prices reset pretty quickly, systems hiccuped, and a bunch of tickers momentarily displayed a catastrophic drop that never happened. No panic required. By the way, and while we're on the subject, I actually think Netflix could finally be a compelling buy, but not because I suddenly think streaming or the company is going to see a resurgence, but simply because the lower prices are going to attract an entirely new group of starstruck investors who previously found shares too expensive. Computers too. So how do you play this? Well, leaps, calls, and heck, even just the stock could be good. So think about it. Number 4 today, Jassie's master plan. Fire thousands and pray the GPUs invent something that Google didn't already. This makes me crazy, but Amazon is raising another $15 billion. Officially, the story is about investing in AI. Now, unofficially, it's about keeping up. Meta, Microsoft, Google have all built their AI engines years ago, or at least some semblance of them anyway. Amazon is busy playing catch up at eye-watering scale. $125 billion in capex this year alone and more coming down the pipeline. Debt markets are footing the bill for now, but that doesn't magically turn Amazon into an innovator. It seems to me that nearly every big move Jassie's making lately is reactionary. Layoffs to cut costs, AI deal to close a gap, bond sales to fund a race. They're already late too. Now, Wall Street, of course, may love the spending, but I remain unconvinced it translates into durable leadership, which I think is the real problem. So I'm going to pass on Amazon. Stock's probably going to do okay, but I want to do great if I can get it. Call me crazy that way. Keith's investing tip in this department: you don't win the arms race by being the last one to build the factory. You buy the innovators, not the imitators. All right, and finally, number 5 today, Emirates has told Boeing, try not to screw this up this time. Emirates just handed Boeing a $38 billion order and a warning. So the airline just bought 65 more 777-9s this week, taking its total Boeing order book to a staggering 315 jets. But this wasn't a victory lap like people think. Emirates president said point blank he's holding Boeing's feet to the fire after years of delays, certification issues, and production setbacks that forced the airline to spend billions of dollars retrofitting older planes just to keep capacity up. Now, the message, as I heard it, was loud and clear. Here's the order. Now prove you can deliver, or else. Now, my POV, at the risk of sounding like a broken record, this is exactly why I remain cautious on Boeing. Demand isn't the problem. Trust is, something I have written to you about many times. Hope isn't an investment strategy. It never will be. So trade idea in the meantime, Putskis. I think there's a good case to be made that Boeing returns to $150. I wish it wasn't the case, but it is. Anyway, today's bottom line: fear is a powerful anti-motivator. Yet at the same time, it is one of the single biggest and most compelling opportunities if you can overcome it. On that note, and as always, let's make it a great day and start the week strong. I've got some shopping to do. You probably do too. I hope you break out your buy list. You got this, I promise. Thanks for watching. I'll see you tomorrow. Cheers.